Welcome to the Passive Investing Made Simple Masterclass. My name is Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And today we're going to talk about Beyond the Broker, how to find smart passive investments without being an expert. Now, maybe you are new to passive investing, or you've done a couple deals and you're just like, why did my broker not tell me that investing in real estate in, say, equity deals, or even going into debt deals where I can make consistent cash flow month over month? Why didn't they tell me that I could do this? How come I can't get access to this on my Vanguard platform or my Fidelity platform? Well, today we're going to demystify like what passive investing is, but also like why these things aren't necessarily put in front of you. Now, before we do that, we do the show live every Tuesday to help you learn the ins and outs of passive investing, turn that active income into passive income and long-term wealth. So maybe you've tried to invest in a passive deal before and just couldn't get comfortable making an investment. Or you actually invested in a passive deal before and discovered, wow, this deal just wasn't the right fit. I thought it was going to do one thing, but now that we're in it, it actually does something completely different and it's not aligned with my goals. Or maybe you just simply want to sharpen your skills and learn how to be a more solid, formidable passive real estate investor. If that's you, you're in the right place. Now, if this is the first time you and I are meeting before, again, my name is Whitney Elkins-Hutten, and this picture tells the whole story. This is why I invest in real estate and, more importantly, in passive real estate. And so I can do what I want when I want with the people I want to do it with. And we spend a lot of time as a family traveling out in nature. That's my jam. That's what I love doing. And it's really my growing this portfolio of over 800 million in real estate and various partnerships, active partnerships. That's what has allowed me to get here. Now, I have transitioned a lot of that portfolio into passive real estate investments, and I'm going to show you how to do the same. And I get to impart this information to you as the Director of Investor Education here at passiveinvesting.com. If you're interested in learning more about my journey, you can check out my personal website, ashwealth.com, or my book, Money for Tomorrow, How to Build and Protect Generational Wealth, which you can snag on Amazon or Bigger Pockets. Now, all of this is to serve one result. Okay. For me as a passive investor, I want to have 100% choice and freedom on how I spend my time. I work extremely hard, and I'm sure you do too. And I want to show you how I have been able to leverage different aspects of active and passive investing for you to have a similar result in your life. Now, you may be sitting here and going, wow, I actually, I'm here to learn how to be financially independent or maybe even financially free. But remember that financial independence and freedom is a tool to get the other things in life: location independence, choice, time, and maybe even the ability to create an impact in the world. And we can help you do that here at passiveinvesting.com, whether it's through our equity investments or through our debt investments, our PIC Real Estate Debt Fund, which we'll talk a little bit about later on today. Now, I invite you to unlock your potential or your real estate investing potential. You can check out the Passive Investing Club. You can join it there at passiveinvestingwithwhitney.com or scan the QR code there. You get a personal one-on-one call with me to learn about aligning your investing goals. You'll get priority access to our open deals and more investor resources to help accelerate your growth. Okay, so we started off today, discussing why on earth did my broker, my fiduciary advisor, not tell me that I can invest, take my hard-earned dollars, my retirement money, and invest in real estate? Or maybe why didn't they tell me that I could take part of my income from my business and invest in real estate? And oh, by the way, I don't have to clean the toilets, manage the tenants, don't have to take care of the trash. I can invest in partnerships that allow me other operators to do that for me. Now, we're going to demystify that today, but I want you to know this isn't for education purposes only. So make sure that you are in partnering with your investing team, your tax advisor, your legal advisor, and if you want to, that financial advisor, before making any sort of investment decision. Okay, now before we can start unpacking why your broker or your fiduciary advisor didn't build out part of your portfolio to be able to invest in real estate, we actually have to define what it means to invest passively. Okay, so we have passive investing. We can define it into two terms. What it means in relation to how you make money, and then in relation to how you spend your time. Now, you personally can go buy a single family rental property and rent it out and manage it yourself. Guess what? That technically is considered passive income by the IRS, just how it gets classified. All right, but that does not mean your time is passive. So when we talk about passive investing here, we're talking about how can you maintain the highest and best use of your time and take your income and go invest in another deal to where somebody else is doing all the work. Okay, so it means placing your capital into a real estate backed asset where somebody else is operating and managing it on your behalf. Now, it can be an equity deal, or it could be a debt side of the deal, or it can be some sort of blend of the two. Okay, but you ultimately are doing your due diligence, your research. Okay, you're vetting the deal, making sure it fits for you. Okay, and you're contributing your capital to the deal, but all the day-to-day operations are done by the operator. Now, here's the power of investing in passive investments, otherwise known as syndications, is that it allows you to, one, pool resources with other investors to get access to deals that you probably couldn't get access to on your own. It probably gets you access to higher quality deals. You could actually divide up your capital across multiple deals, multiple operators, multiple markets, multiple parts of the capital stack, okay, to create diversification beyond what you could if you were investing individually. So it's a very powerful tool. Now, why don't brokers actually bring up these opportunities to you? I mean, if they're so great, why doesn't your regular Vanguard or Fiduciary or Fidelity or Charles Schwab advisor talk to you about these? Well, quite frankly, they don't have any specialized training when it comes to these type of assets. Most of those, advisors that are selling, they have a different types of securities license that doesn't cover, that is literally the education doesn't cover the syndicated type of investing. But even if you had your own fiduciary advisor, they still probably lack training when it comes to real estate syndications, okay? And they just don't know how to properly underwrite the deals. Two, they have an entirely different focus. Okay, brokers are focused on products that they can sell and that they can repeatedly sell that take very little work from them to sell. Okay, so when you do run across that rare broker dealer that is versed in real estate syndication, they put a lot of time and effort into their education. They've put in a lot of time and effort to understanding the investment, and they're putting an immense amount of time and effort into actually, quote unquote, selling that investment to investors. Okay. Most financial advisors, financial fiduciaries, they're just not doing that work. Okay. It's not easy for them. They'd rather take the low-hanging fruit. All right. Which leads me to the third part. Okay. The compensation model for a regular financial advisor to be able to do all this work, to get trained, to understand the investment, do the underwriting on the investment, and then resell the investment. They can go sell, 10,000 shares of Apple stock and get paid a lot quicker and maybe a lot more than they would if they, sold 100 shares of a particular syndicated investment. So there's just no established methodology, compensation model on syndicated deals. Okay. And there's just not a clear compliance pathway for them either, unless they have a particular type of broker's license, which most of those brokers are not going to spend the time nor money to go get. All right, so we aren't actually blaming financial advisors here, okay? It's about understanding the limitations of the traditional investment space. It's designed for quick, repeatable sales that take minimal effort but get the highest compensation. So if you want access to these type of deals, it really boils down to you investing your time and energy and knowledge to be able to understand the deals, vet the right partners, and make sure that it aligns with your investing goals, which we've been talking quite a bit about over the past few weeks. So first piece here, as we start to bring on, these more syndicated deals into our portfolio, diversify our portfolio a little bit more, is that you need to know who you're investing with, right? If you're going to do a real estate syndicated deal, you don't have a financial advisor or a financial fiduciary, I'm doing that in air quotes, that is evaluating that deal technically on your behalf. All right. So guess what? You have to become your own fiduciary. You have to now do all of that investigation to make sure who you're partnering with is going to be the right fit. Now, vetting an operator, we're not going to go completely in depth on how to vet an operator. If you take a look at our passiveinvesting.com YouTube videos and spell out .dot, I have tons of boot camp videos on there that tell you how to set up your investing goals, how to understand your risk profile, how to vet operators, how to vet markets, how to vet deals. So we go very deep into that, but I want to make sure we do this at a high level today so you are, at least pointed in the right direction. So vetting the operator really matters here because there's some common pitfalls, and then even if we sidestep the pitfalls, we got some friction points. So the pitfalls is, not all of the time, the reason why we want to vet operators is we want to make sure, as a limited partner, you want to make sure that you are aligned with the operator. Okay. So you're putting your hard-earned time and money into a deal that to buy the operator's time, knowledge, expertise in order to run the deal. You want to make sure everybody's making money together. Or if the market turns challenging, that you guys are aligned to where you are true partners and everybody's taking the hits together. All right. We don't want to disparage one class or another because guess what? We're partners. All right. Now, if you were going in a debt deal, the relationship's a little bit different. Okay. But we want to make sure that the incentives are aligned, not misaligned. Okay. We also common pitfalls, that some of my limited partners experience when they don't understand how important vetting is that sometimes they go into assets that have unrealistic expectations. I am guilty. I have invested in an asset that had completely unrealistic expectations, and that in and of itself was very tempting to overlook some of the red flags that were being thrown by that operator. Another thing that we want to vet the operator for is to make sure that the fee structure is aligned with the compensation to the deal and doesn't put necessarily the investor returns at risk. So I can think of one operator in today's environment that is in very challenging situations, and they are continuing to take their 3.75% fee, deal over deal over deal. And they have not aligned that reduction in fee on some of their deals that are being challenged in the market. Okay. So again, we want to make sure when we're vetting the operators that we see complete alignment and realistic expectations. Now, where does that create some friction point here? If you as a limited partner, don't have a good vetting model in place, okay? And even if you do sidestep these pitfalls, if you don't have a good due diligence system in place, you still might be a little fearful of making costly mistakes. You might still be a little skeptical. Is this deal for real? Like, is it really going to have the potential to pan out here? And then maybe you just get so overwhelmed by all the different moving parts and the terminology here, you just don't know where to start. Okay, so that's where we're heading to next. I want to make sure that I'm arming you with a solution, a 5-point vetting checklist that will help you start building clarity and confidence in your investing decisions. So let's dive into that. Okay, so in the 5-point vetting checklist, step number one is that when we are vetting an operator, we want to make sure that before we even jump on a call with them, that we're doing a little bit of research, even if it's really like 5 minutes, to make sure, one, that there's high level alignment. Okay, what you see when you get on the call, you're essentially confirming what you already know. Okay, trust but verify. Okay, so uh, how do we actually do this pre-call research? Who are we going to reach out to find these operators? Well, first, we want to maybe ask for some personal referrals. We want to go to investor conferences. Maybe we turn to an investor community, that has, honestly vetted operators on there, not just paid to play type operators. And then, we can do our web search. It's not my actual fave place to like rely on a ton of due diligence. Just with AI, I've actually seen new operator websites that were AI generated, and when you talk to the operator on the phone, they have no idea how to invest in real estate. So you have to be really careful. This is super important. Okay, so we want to be cautious. We want to make sure that we are not, looking at unmoderated forums. Okay, we definitely want to stay away from those flashy AI generated websites. Okay, no problem, no harm if it's an AI generated website and we got a trusted team behind it. Okay, and then we want to make sure that if we are on some sort of platform, to where we are vetting operators, that that platform is disclosing to us how the operator is getting on there. Is the operator paying a fee to be on there? Are they charging a fee to the investors to be on there? We want to know who's making money and why. Okay. So that leads me to the last statement. Always ask who's getting paid for introductions and for recommendations. Okay, because that will, impact what quality of lead you're getting. Okay. Now, once you find these lists of operators and you kind of do a high level research, either you got some great traction from other investor friends, or maybe you read good comments online, we still want to get on the call with them. Okay. We want to, again, trust but verify what we're seeing. Okay. So when we're on the call, we're going to try, essentially checkpoint 3 different areas of the conversation. So if you have a 30-minute call, try to pace out 6-7 minutes for each of these areas and leave a little bit of time for kind of clean up Q&A at the end. So the first part is we want to dive into strategy and execution. What is their specific investment strategy, their market focus? Okay. Based on their strategy, who's the team behind them that does all the magic? Okay. Do they have a team that does day-to-day operations? Okay. Also, part of that strategy and execution, how frequently and transparently do they communicate with investors? You can ask for copies of previous communication to investors in order to verify this. We want to verify their track record. How many deals have they done? How many have gone full cycle? Okay. And when I mean full cycle purchase to actual sale of the asset. What were the projected versus actual returns on past deals? Now, we're coming out of a very challenging market environment. I don't expect all operators that I talk to have a clean slate, but I do want them learning from their past experience and carrying that knowledge forward into future deals. And I do want them being transparent with me of when I ask the question, what did they see? What did they do? How did they pivot and navigate the asset? Okay. And then we get into the third category, which is operator alignment. Okay. Is this, you know, what capital, work that you do, is this your full-time focus or just a side hustle? Okay. The operators have to get started at every different level of the investing game. And you have a choice on who you invest with. My encouragement to you as a high net worth, high accredited individual is to focus on operators that are doing this full time. Also, look at how much capital that they're putting into the deal. Again, creating alignment. Again, operators have to get started at all different levels. Maybe if they're just starting out, they don't have the capital to put into every single one of their deals. However, again, you have a choice. Is that operator putting in, say, 5, 10, 15% of the actual capital stack into the deal? And then I always like asking the question, how are you as the operator compensated? Okay, this doubles down um, to you understanding how the waterfall generally works in each one of the deals. So make sure you're taking key notes when you talk operator to operator. Okay. Now, most investors, they'll get on the phone. Okay. Hopefully this isn't you. They'll hold a call and then they get off the phone and then they go back to their day-to-day job. They kind of forget about things until they're ready to invest. And then they were like, what kind of conversation did I have with that operator? I think it was good. Great. I'm gonna, write a check and invest. All right. So we actually want to think about that, the call, create some space, maybe set aside 15 minutes after the call and think through, kind of do a little bit of post-call analysis in your head. Um, did they not answer a question? Were they really vague? Did they deflect? Did they avoid? Okay, were they excessively polished? Was everything really rehearsed? That's almost like a red flag in and of itself. Okay. Did they provide unrealistic expectations for you in that deal, promising, returns that were too good to be true? And then did they use extreme pressure tactics? You know, hey, I have one spot left in this deal. If you want in, you got to let me know by 2 o'clock today. Now, that could be true. And you want to, tease that apart from, there actually only being one spot left and then it being a high pressure tactic tool, creating artificial urgency. Now, I encourage you to take a screenshot of this. This is a summation of one of our managing partners, Dan Hanford, an article that he wrote on the 8 red flags to avoid for any investment. And so this is a culmination of all of his work, part of his due diligence system, he and his wife investing in, I think now over 80 equity deals. And what they look for, if any one of these are true, they're out. Okay, so the 8 red flags to avoid, some of these we've already covered. No successful background in business. All right. They're a part-time operator, not working in the business full time. Red flag number 3, only one managing partner or the managing partners are related. This is the checks and balance system. It's kind of like having the 3 different branches of government. If we want to have multiple partners, okay? But ideally they're unrelated, okay? That way, one partner's actions don't affect the other partner. They can kind of counterbalance each other in decision making. Red flag number 4, maybe if there's not a preferred return in the deal, that might be a red flag for you. Okay, question it further, why is the operator not set on giving away a certain allocation of that deal to the limited partner? Or if there is a preferred return, but there's what we call a general partner catch-up in there, meaning that the general partner actually gets a part of their money before the limited partnership gets their cut of the initial profits, that could be a red flag. Number 5, modeling a refinance into return projections. Now, the simple way around this is ask for the underwriting on the deal, and you can back out the refinance line. If the deal still works, hey, that might be a deal to consider. But you'll find more often than not, if the refinance line is included in the analysis, the deal probably has to have that refinance go through for it to work, which could be a red flag that, the all stars have to align in the market. Okay, red flag number 6, distributions as a return of capital reverses distributions being a return on capital. Now, I have taught to many of investors and even operators, tends to be more of a matter of preference, but just know over time, if your distributions are a return on capital, you are dividing up your tax liability over the years of the hold. Whereas if your distributions are a return of capital, you're saving your entire tax liability for the end of the investment. So there could be some surprises. Red flag number 7, no skin in the game from the operator. We've talked about that. And red flag number 8, floating rate loans with no interest rate caps or extensions. That's a big red flag. If you've been in the real estate syndication business or as a limited partner in the past 3 or 4 years, you are well aware of that situation. Okay, so we talked about why your broker-dealer never brought you these deals, okay? As you can see, there is an immense amount of knowledge and education expertise that they have to be able to vet that deal. They're just not compensated to do that. So that means you have to take on the role of being the fiduciary. And the first step that you need to be savvy about is, how do we vet the operator? So we've showed you where to find some operators, how to initially conduct that call, what you should be doing for a post-call follow-up. Step number 4, now is decision time, okay? You've done all this legwork today. If red flags are popping up all over the place, I want you to unsubscribe to the operator right now. Get them out of your inbox. We save your time and precious time and attention for the people that do resonate with you. All right. If you're just like, okay, I like what they do, I want to get to know them a little bit more. Let's date a little bit. Let's read some more information about them, see some of your deals. We're going to defer. Okay. So place them on a watch list. Okay. I like creating filters in my email inbox and having all of that communication go into a filtered inbox or folder in my inbox. And then I sit down Friday afternoons and I read through all that investor communication. All right, place them on a watch list, revisit at a later date. If you are ready to go into an investment, engage. Okay, if you're impressed, engage, move deeper, get into due diligence on a deal. Okay, take action. You're going to learn so much more about placing a small investment with that operator than you were if you're going to sit on the sidelines. Now remember, our goal isn't to find as many deals as possible, but to filter out as many operators as possible until we only have the ones that we want to invest with remaining. Okay. So this is for you, could be a paradigm shift. You might be looking at different operators and trying to look as many deals as possible when we really should be looking as many operators as possible, finding those sweet spot of operators, and then we look at their deals. All right. So I most recently worked with a physician on, their vetting process before going into multifamily syndication. And she discovered that she actually didn't do that great of a job with vetting an operator. It came from a friend of a friend. She thought her friend did all the due diligence. And turns out that wasn't the case, because her friend also relied on another friend who they thought they did the due diligence. But at the end of the day, that particular operator misrepresented their track record and the business plan to them. Now, here's the thing. She followed the vetting process as we've laid out on our Passive Investing Made Simple materials, our videos, our checklist. And here's the thing. She was like, I'm going to push pause. I'm going to watch for a little bit. So she passed on the initial investments. Come to find out, that tool, that process really works. She was able to preserve 100% of her capital within a year. That particular operator um, got caught up in a Ponzi scheme, and a lot of investors wasted a lot of money. Now, you might go, Whitney, this is a lot of like generalities. Well, of course, we're not here to air out other people's dirty laundry, but these things do happen. But here's the thing, those red flags will show. You just need to have a process in order to find the red flags. Okay, so what are your next steps? Your next steps is to rewind this video and establish your vetting process. Follow that 5-point operator vetting checklist. Okay, have your process in place in order to find those credible and aligned partners. Step number 2, hold the critical conversations. Make sure that you're getting on the phone with every single operator and their team prior to making an investment. Ask those questions that we post. All right, that's just the beginning of an operator due diligence checklist, but those questions are going to uncover an immense amount of information for you. Step number 3, after the call, make sure that you sit down with a clear head immediately after the call and go, hey, are any of these 8 red flags showing up for me right now? If so, I'm going to push pause for a moment and ask some clarifying questions, or I'm going to move on to step 4, which I'm going to delete, defer, or engage. All right, last little nugget of advice. Okay, I encourage you as your deals cycle out, okay, you may want to jump right into the next deal with the same operator, and definitely consider that, right? But do a quick really reevaluate. Has anything fundamentally changed with the team, the strategy, or the performance of the business? Okay. If so, ask questions, clarify the direction before reinvesting. All right, guys, we have come to the end of today's masterclass information. Again, this is your invitation to join the Passive Investing Club, where you can jump on a one-on-one call with me to discuss your investing goals. And you can get our other comprehensive investor resources to accelerate your investing growth. If you're live, don't go anywhere. We're about to start the Ask Me Anything part of the show.